Thanks for tuning into yet another episode of Insight. We're trying to get some of the best asset managers to try and talk about one favorite pet theme of theirs and why is it that they believe that the pocket looks interesting and maybe the company within pocket is doing interesting work as well. Our guest today on the show is Aditya Khemka of Incred. We love having him and it's no different today. Aditya, good having you. Thanks for joining in.
Thanks for having me.
So Aditya, tell us, we know you as a healthcare expert and you have views on various facets within that space. What is the key insight and on which space are you going to talk about today?
So today I'd like to discuss diagnostics with you. And I think that's a space where there's been a lot of chatter, a lot of disbelief in the last 12 months, and which was preceded by almost a 2-year euphoria in the space. So, we as asset managers believe in more stability in business models and more stability in economics, whereas the market always somewhat like a pendulum, swings to extremes. So we think and we believe that during the COVID period, the market swung to one extreme where they thought diagnostic was even better than FMCG and stuff like that. And today, I think the market is swinging to the other extreme where they're saying that the business model is disrupted, the volume growth is gone, the pricing ability is gone, and so on and so forth. So I think it's a space now which is one under earning pressure because most of these diagnostic labs have spent a lot of money in expanding footprint, in adding capabilities, and therefore, these investments are all operating expenses, that add to the P&L. And today their P&Ls are depressed, their margins are depressed, and to add to that, these stocks are derated. Niraj, whenever we find this combination that the earnings have fallen temporarily, if we believe so, and the multiples have derated, and if we have reasonable belief that the earnings will go back up, it's a perfect recipe for wealth creation. Because once the earnings do go back up, the multiples also go back up. And as an investor, you don't only make earnings growth, you also make what is called multiple re-rating. So there is a double bonanza for you at the end of this investment thesis.
Okay. Well, I'll be interested in understanding from you, why is it that you believe that this is the right time to time the cycle, if you will, if we can call them cyclical in the first place, because they have done at least one cycle of sorts since the time the first of the companies got listed. Maybe we'll try and do that in our conversation with one of the diagnostic companies, Aditya. At your behest, we've invited Rahul Guha, who's the CEO of Thyrocare, to join in on today's show. And let's try and understand from him what he thinks about quote unquote, the cycle that we're talking about. Rahul, great having you. Thanks for joining in. Hope all is well. My name is Niraj, and we've invited Aditya Khemka of Incred to talk about the diagnostic space, and at his behest, we have you here. So thank you so much for taking the time out.
No, thank you, Niraj, for having me, and good to see you again, Aditya.
Okay. So Rahul, just a quick opener from my end. From the time that these businesses got listed in say maybe 7 years ago, if you will, one can argue that the growth has been in a good way volatile. It was running at a particular pace until COVID happened. Then there was a really sharp acceleration in growth for all the right reasons. And maybe relative to COVID, but there has been a deceleration in growth from those levels. Now, I would love to understand from you, when you think about your business, do you think about it as one which will be cyclical in nature, moving around in terms of the growth rates being cyclical in nature, or do you believe it could be structural in nature at some point of time?
Got it. Look, Niraj, the overall diagnostics industry, if you look at healthcare in India is underpenetrated, diagnostics in healthcare is underpenetrated. The organized to unorganized ratio in diagnostics is also underpenetrated. So this is a vast ocean of opportunity that sits in diagnostic. So I think to say that, we are in a capacity cycle that would lead things to be cyclical is probably not true. I mean, I think there was an aberration that came through COVID, which was a large spike in a particular type of testing. But I think the structural tailwinds for the diagnostic industry and the healthcare industry in general have been there for a long time, and I don't see them going away for actually quite some time to come. Even if I look at this year, I think most of the players have now recovered back to their historical growth rates, the non-COVID business, and are looking very ambitiously to grow from here.
Just a quick follow-up before I get in Aditya in this conversation as well, because I'm sure he has some insightful questions to ask you, Rahul. But the question that people might have, and maybe Aditya also at the end of the show might answer that, the question that people might have is whether in the near term, and by the near term, I mean the next 3 or 4 years, could the growth come at the expense of some key metrics? Because as you said, the runway of growth is vast, so you might want to invest heavily into capturing that slice of growth. And therefore, could it, even if the growth comes in at a breakneck pace or the long-term averages, could it come at the expense of some key metrics because you are investing heavily?
Yeah, I think, look, the large opportunities, as I've always been saying, sits in tier 3, tier 4 markets. And that requires a certain amount of field force, feet on the street to go and penetrate those markets. But that's more like an operating cost. I don't see large investments in capex and things that like that. So I would say, yes, you could expect a little bit of margin dilution as we invest for growth. But, I don't see heavy leveraging of the companies or, very large capex footprints coming about. But yes, you will see some dilution as we invest into tier 3, tier 4, which has been terribly underserved, and at least for us is a huge opportunity. If I look at our numbers, our tier 3, you should know Thyrocare is almost 75% plus tier 3, tier 4 penetrated. So that's where our bread and butter comes from. That market grows at 2x the metro growth, so for us, that is certainly something that has been helping us demonstrate the growth that we've been seeing. And we continue to double down on that.
Okay. Aditya?
Yeah, so on that round, Rahul, then if I were to look at the margins of Thyrocare, before, let's say 3-4 years back, Thyrocare used to be a 40%, 38% EBITDA margin business consistently. And obviously, since the new change in management, the old promoter went out, the margin trajectory has sort of decelerated, and today we are at 25%, I think, or in the year of FY23. So I would like to understand from you, what were the blocks that took the margin down from 40 to 25? And in future, I know you can't give forward guidance, but at least what will take the margin back up, if at all, as you see it, let's say 3 years down the road? I don't want the next quarter or the next year, but we are talking about, let's say, over a 3-year horizon. Where do you think the margin can be, and what will be the building blocks of the margin going back to a certain level?
Okay. See, first, let me just set a bit of background, right? If you look at Thyrocare between FY18 and FY22, which was the kind of time that we took over, the overall growth rate was, I think about 2% CAGR, the non-COVID business. So this was a business, while it did enjoy 40% or 38% EBITDA margin, actually didn't grow at all over a period of 4 years, the non-COVID business. So the question then when we took over was, where were we going to invest in growth, right? Because we finally wanted to aspire to a industry leading growth number. So we took 2 calls on investment, right? And that's largely where the margin dilution has come from. The first was in improving our quality standards. So we invested in pathologists in every lab, which we never had. So today we have a staff of almost 40 plus pathologists in Thyrocare who oversee the reporting and ensure that an accurate report is provided to the patients. And then the second is we invested in a field team, right, that would go out and talk to doctors, talk to different pathology labs, and ensure that the Thyrocare brand is not just communicated from a call center in Mumbai, but actually with feet on the street on the ground. So those are 2 big investments we made in manpower. And the other investment we made, recognizing that turnaround time is going to be a big competitive advantage in this business. We opened a number of regional labs, to service that demand. And as a result, our rental costs, because earlier we were much more centralized, as we got decentralized, our rental costs started to come up. So our overheads kind of increased and brought down the margin. Normalized for the ESOP charge and everything, we are already at about 30% EBITDA. Right. And as I look going forward, we should get decent operating leverage on the manpower cost for sure. And on the expansions of labs also, we are more or less done. Today, if you drop a pin anywhere in India, there is a Thyrocare lab within 200 kilometers anywhere in India, which means that we can do same day reporting almost across the country. So I don't anticipate us investing more heavily in more regional labs. We have 26 of across the country. 20 are NABL accredited. So we offer a good quality report across the country. So I expect operating leverage to start to kick in over the next 3-year period. Some of the growth has already started to come in. As I said, we delivered almost 20 plus. If I just go by 9 months extrapolated for this year, we've delivered a 20% growth rate with these investments. And I'm hopeful that trend continues over the next 2 to 3 years, and we're able to then deliver the operating leverage. So in a nutshell, yes, it was a 38 to 40% EBITDA company with zero growth. We have come down to 30% as we invest, but already hitting a trajectory of 20% growth. And hopefully, if that continues, the operating leverage will kick in on that cost structure, because by and large, most of it is fixed, and we should see very healthy margins in the 3-year time frame for sure.
Right. Just one more question on the growth that you talk about. So you on earning calls, you have talked about the 3 pillars of growth that you expect to drive the business. So I think one of them is your expansion in PIN codes. The other is the API holdings business sort of helping you, and third is the market growth rate. So could you walk us through your current situation as to how each of these 3 pillars are helping you, and outlook on these if you want to share it?
Sure. I think market growth rate has kind of normalized. Everyone is reporting in the 10 to 15 range is where we are looking. And that, Niraj, to your original question, also used to be the secular growth rate of the industry. I don't think any of those tailwinds have changed, right? It's not like healthcare penetration has peaked or diagnostics penetration has peaked, and unorganized to organized at best would be about 15%. So there's enough and more for that secular trend to continue. So I would continue to bank on that. Our PIN expansion or our geographical expansion continues. When we first took over this company, we had about 2,500 transacting partners. We are now at about 6,600 transacting partners, that have worked with us. So that continues to enter into our base, support us quarter on quarter as we grow. Of course, not all of this is new organic. Just to give you a sense, in 2019, we used to have about 4,500 transacting partners. By the time we reached 2022, we were down to 2,500. We've been able to recover back to about 6,600. A lot of that is old partners who have come back to the network, and we've added on top of that. So that has been encouraging us on the PIN expansion. As I said, 75% plus of our business is tier 3, tier 4 markets. And that is growing very, very fast, because with our regional lab network in each of these markets, actually, and most of our regional labs being NABL accredited, we offer a very affordable quality product to these markets. And our penetration is actually unparalleled compared to any of our competition. So I think that leg is going very well. The third leg, which is our partnerships, of which, of course, API Group is one of the largest partnerships, but we have partnerships with actually every e-pharmacy, every online consultation platform, every surgery platform. You name anyone who's in the health tech business actually works with Thyrocare for their diagnostics. I think that sector has seen a bit of headwinds. There's been clearly, a pullback towards profitability. So the burn model certainly has come down. You no longer see the pricing that people used to talk about, not just 6 months ago. I mean, nobody is offering the 100 rupee tests anymore. Pricing has normalized both on individual tests, even on packages. I think most people are reporting between a 20 to 30% price hike. That at least the newer players have been kind of readjusting their price package. The pricing pressure also has eased off. But that has resulted in, a slowing down of the hyper growth that we used to see linked to the burn model. So I would say we don't heavily bet on API as much as a growth engine. But over the last 6 months, we've been adding almost every single health tech player into that mix of our partnerships. And so we've been able to kind of compensate, by adding new partners to be able to deliver a growth rate on our partnerships. That being said, I would say over the next 3 years, I'm more bullish on the market recovery and our expansion into tier 3 and tier 4. I think the partnerships business will largely be a metro phenomenon, which will be a heavily competed space. Um, let's see how that plays out. But we have at least diversified our partnerships to ensure we have a sufficiently normalized base.
Over to you, Niraj.
Oh, okay. Aditya, you can have more. I have one question, so you can ask more if you want to. But since we are on that topic, let me just quickly squeeze in one question, Rahul. At a point of time when everybody's talking about growth happening through digital methods, yeah, I've heard Aditya on number of conversations with me talk about the importance of the brand building and the point of sale or the actual physical presence also being very important in this business, unless I'm wrong, Aditya. And the fact that even if there are branded digital players coming in, they fail to make a dent to the brand perception of the existing diagnostic leaders, if you will, you or a metropolis or what have you. My question to you is, how important would this be over the next 5 years as more and more India goes digital and more of these tests become regular tests and do not become that once in a year wherein I have to be making sure that I definitely go to a branded player which is next to my home, because I have to do these tests multiple times because they will be needed to be done that way.
Yeah, look, I think the digital players certainly bring a lot to the table, right? Particularly from the experience point of view. At Pharmeasy, we developed the on time or free value proposition, which was to say if the phlebotomist does not come to your house on time, then the test is free. And that is really, from a customer point of view, also a lot appreciated because you're typically fasting 10, 12 hours. If you don't know where the person is, starts to become, you get hangry in these kind of situations. So some of that certainly has helped. There's so much transparency on the cold chain, how, when your report will come in. I think the digital players forced us also to look at our game in terms of turnaround time, in terms of, reporting time. And we also looked at our processes to ensure that we would keep up. So I would say, look, the digital disruption certainly made us relook at almost all aspects of our operating, right? Because suddenly you have someone offering 6 hours report, and then that forces you to think and say, why can't we do it, right? What's the challenge with us? You had someone offering on time or free, and we said, let's see how can we ensure that our service delivery is there. So I would say that disruption certainly asked us all to up our game. But at the end of the day, for Thyrocare and for many of our peers, right, our vast network is our competitive advantage, right? The ability to source volumes. We do almost 3 lakh tests a day, right? That sits in our overall competitive advantage, our sourcing structure, our lab operations, and it allows us to be more present than anybody else. And so therefore, whether you're looking for a test for yourself in Mumbai or for your mother in Jharsuguda, or for your uncle in Jhansi, then actually Thyrocare has an option for you. And, you can pay online and do the booking and all of that. And we all have, families that are spread out across the country. And I think that's a powerful proposition. So I don't think the physical network is going anywhere. I think digital plus physical will complement each other.
Got it. Aditya, I have questions, but if you have, might as well you ask them.
Sure. So a couple of points on this, Rahul. So if you look at the way Thyrocare has grown over the past, again, 4 or 5 years, as you said, the non-COVID growth was very, very tepid. And COVID obviously also moderated the non-COVID growth because people were not going out. Now, if I look at the way forward, right, given that 75% of your business comes from tier 3, tier 4, where I would believe that you don't have much competition, at least organized player-wise. You would have competition from unorganized mom and pop stores, but you wouldn't have as many organized players there. How critical is pricing strategy there? So you are obviously an affordable diagnostic player. So how critical is a low pricing as a strategy? And from where you stand today in terms of your margin profile, would you need to sacrifice more margin going forward for better growth in tier 3, tier 4? Or have you already done the investments and the margins can remain or improve from where they are while you continue to grow in tier 3, tier 4?
Yeah. Our biggest investment would have been, Aditya, to get the lab network out there so that we could service customers in a appropriate time. You can't have 48 hours turnaround time. You have to be able to give the report either the same day or the next day. Nobody requires it in 6 hours, but at least the same day or the next day is what. And I think that journey is more or less done. As I said, you drop a pin anywhere in India, you'll find a Thyrocare lab within 200 kilometers. In 200 kilometers, I can get the sample to the lab in 6 hours. So, that solves a lot of the logistics challenges that we have. I think we still need to go out and talk to people. And for that, we will continue to invest in the field force and our central calling team that onboards new partners in each of these tier 3, tier 4. But even today, if I go to a tier 3 town, our pricing actually, when compared to a local tier 3, tier 4 lab, is already better, along with our quality and our logistics backup. And the reason our pricing is lower is because we have the power of 300,000 tests a day, whereas a local lab is procuring for 10 tests a day, right? And his reagent cost, overhead, and all of that is managed in that front. So I don't see us needing to further compete on price. I think it is just about getting the Thyrocare story out there, saying that at the same cost that you are getting a thyroid in, let's say, let's say Udaipur, I'm not even going that deep, but the same cost that you're getting a thyroid in Udaipur, I can give you a report within 24 hours from an NABL accredited lab, right? That is a powerful proposition in these towns. And that's what we are betting on. We're not going to go down the price.
Right. And just one last question from my side before I pass on to Niraj finally. There's a lot of perception amongst investors and the common public that because of these online discounted platforms, there is a lot of pricing pressure. I know you touched upon this in your previous comment, but I would just like you to elaborate a little. So since these discounted platforms have come with discounted pricing test strategy over the last 12 months, how has been your pricing strategy different from what it was earlier? Have you had to reduce prices? Have you had to adjust prices? We of late heard Dr. Lal taking an 8% carpet price increase across their tests. So can you just walk us through what has been the difference in the pricing strategy over the last 12 to 24 months since these discounted platforms have come online?
So actually, we were always an affordable option. Always tried to be as low cost to the patient as possible without any compromise of quality. We maintained that strategy. So actually, we never had to go down on price. We didn't go up on price either, but we never had to go down on price during this entire, let's say, competitive intensity that we observed, I would say, about 2 quarters ago. In fact, now many of the players that are in the online space partner with Thyrocare for their tier 2, tier 3, tier 4 diagnostic testing needs. So actually, we work with most of them to help them expand their networks in some of these other regions. And that is largely because we offer an unparalleled network at one of the lowest costs that you would see.
Yeah, over to you, Niraj. Thanks, Rahul.
Okay, one final question, Rahul, before we thank you. And it may not be applicable to your industry, but I'm just thinking out of the hat. Traditional marketing MBAs would tell us that earning a new customer is multiple times more expensive than retaining an old one. And mining an old customer is doubly profitable than trying to make money from a new customer. So my question is, diagnostic tests usually are considered to be not, how do I say, for lack of a better word, not something that is very, sacrosanct, that I will necessarily go to one lab because the lab has my history for the last so many years, etc. I can go to multiple labs because the doctor has the history. My question is, at some point of time, can the model evolve to the labs like yourselves, telling the customer or offering the customer the ability to mine old data so that there is more customer retention over the lifetime of the customer, as opposed to customer being fickle-minded and not loyal to one particular brand?
Got it. No, excellent question, Niraj. I guess you are a marketing MBA or
Finance MBA, but okay.
okay. A good question from a finance MBA then. But I look, it's an excellent question. I think the paradigm of wellness testing has always been annual health checkup, right? Which by definition is annual or once a year, right? In Thyrocare, what we have done is launched our Jans series, and you should take a look at that. We're just shifting that paradigm to say, why do you need to only check up? You can manage your wellness once a year, but if you have fever, then you do a fever panel, which helps you check dengue, malaria, chikungunya, influenza, all in one shot, so that you're not taking unnecessarily antibiotics. If you have hair fall, then you do the Janch hair fall so that you can see what's at the root cause of your hair fall. If you have a skin dryness issue or a skin peeling issue, then we have Janch skin care, which comes with a dermatologist consultation that tells you what is the underlying cause of your skin. If you're worried about your heart, we have a healthy heart package that allows you to investigate all dimensions of your heart health. We have diabetes, we have thyroid, PCOS, infertility. So we're really challenging that dimension, which is to say, yes, there's an annual health checkup, which you must do, which tests all broad parameters. But if you're worried about something, right, then do a Janch package and see if you can understand what's going on. And with many of these packages, we offer a doctor consultation as well. And the hope is that we can move more health conscious customers such as yourself or Aditya from just, one annual health checkup to really, honestly, if you have fever, you should not be taking an antibiotic unless you're absolutely sure, you have a bacterial infection. So then do a Janch package, figure out if it's a viral. And if it is, then deal with it as a viral infection. Don't just take antibiotics and build up antibiotic resistance over time, right? And similarly, if you're worried about your heart health, we can tell you, your risk factors, all of that through a very simple diagnostic test. So while I'm not a marketing MBA myself, but at least some of that thinking has been launched in our Jan series, and we are hopeful customers will take to that.
Cross fingers. Thank you for all these responses, Rahul. Great having you. Aditya, I take it your questions are done?
Yeah, we are done.
Okay, great. Rahul, then great having you. Thank you so much for taking the time out and all the best for the year or the years ahead.
Thank you, Niraj. Thank you, Aditya. Wonderful chatting with you and good to see you again.
Thanks for your time. Well, viewers, so that's the CEO of Thyrocare talking about a few aspects that Aditya did want to point out, maybe a couple of questions that I asked. Aditya, takeaways. I've heard from you now in the past shows as well that you believe that there's a cyclical uptick. You kind of justified this. Any key takeaway which enhances your thought or challenges your thesis when you spoke to the CEO right now?
No, so I didn't find anything which challenges the thesis. I think there is one point which we haven't discussed earlier and which interestingly Rahul pointed out. That is that 75% of Thyrocare's revenue comes from tier 3, tier 4. Now, if you think about it, the last 4 years for rural India, when I say tier 3, tier 4, it's largely rural. So rural India, last 3 to 4 years have been very, very challenging for them in the sense that during COVID, while urban consumption went up and urban people actually had more savings and more money to spend, rural people actually went out of cash. Because, the rural income, the Indian rural income comes from two sources, agriculture and non-agriculture. Agriculture is only now 1/3 of our rural income. 2/3 of our rural income is non-agriculture. Now, what happened during the COVID era was that the non-agri income completely went away. And this non-agri income basically comes from government schemes, infrastructure, roads, etc., Mandega and all. Now, for the last 2 to 3 years during COVID, government actually stopped the spending on infra schemes. They started spending on social schemes. So rather than giving cash to the rural people by generating employment, government was actually handing out towels and TVs and clothes and food. So which these people can't use to buy services. They can only consume what government gives them. Now that COVID is behind, and now if you look at the budget numbers that we had during this budget, the social spending has dramatically dropped and the planned infra spending has dramatically gone up. Now that again will give cash back to the rural income to the rural population, to tier 3, tier 4 people. And then again, services like diagnostics, like healthcare, and many other such services, discretionary spending, non-discretionary spending, which might have stopped because of lack of income over the past 3 to 4 years, would actually come back up. So in that sense, Thyrocare obviously has always been a play on diagnostics, healthcare consumption in India, but it can actually be looked at as a play on rural recovery, rural consumption in India.
Okay. So before we wrap up the show, Aditya, 10 to 15% growth, let's say for the rest of the decade, if you will, subject to no other disruptions. Maybe some earnings growth if they are able to improve margins from where they are right now. So the profit growth may be slightly higher. And then a multiple expansion if indeed they display this growth and the market believes that there is no further disruption. Is that the principle, and depressed valuations? So all of that you reckon kind of goes into this thesis?
Yeah, so see, an ideal stock in our view is a stock which lacks belief by the larger public, which is why valuations are depressed, which also has shown recently margin depression because they have made investments in their P&L, which will pay off with a back-ended sort of situation. And I think Thyrocare and the consumption pattern should be secular, non-discretionary. So if you look at diagnostics today, they have sort of all three things in place, and which is what makes it a very, very interesting thing for us.
Got it. Okay. Aditya, great talking to you, along with your insights of the questions that you asked the management. So thank you for that. And thanks for joining us on this episode of Insight.
My pleasure, Niraj. Thanks you.
And viewers, thanks for tuning in to yet another show at Insight.